Hey, what's up, my friend? So, in today's episode, I want to discuss, right, how do you tell, right, if a trading strategy works or not? Because I'm sure, right, you have this thought in your mind, or at one point or another, man, does this trading strategy really works? Right, it looks good, but what if I trade it? Then there's a series of losses, right? How do I know whether it's a drawdown or whether it works or not? Yada yada. So there are a few things I look for, right, in a trading strategy, and the most important thing is number one, the logic behind it. Any trading strategy or system that I trade, it must have a sound logic behind it. Take, for example, trend following. What's the logic behind it? Well, trend following, the idea behind it is that you're trading many markets. And in markets, they trend over time. Why do markets trend? It's because of greed, right? When traders are greedy, investors are greedy, the market goes up higher over time. When markets in a recession, when the markets collapse, there is fear, people will sell, and that creates a downtrend. So market they trends over time, uptrend, downtrend, and as a trend follower, we don't predict, we just simply, hop on the move. Market breaks out higher, we look to buy and ride the trend for as long as possible. Market breaks down, we look to short and ride the downtrend for as long as possible. So this is why trend following works, right? There's a sound logic behind it. Number two, once you have a logic behind it, right, I like to find out whether, based on the historical data, right, does the strategy work? So I can just backtest a simple trend following system, right, and see how it fares over the last 10, 20 years, right? So if the backtest results work, right, then there's a good chance, right, that it could work in future. And what's important, right, when doing this type of a backtesting is that your system must be robust. So what do I mean by robust? Let me give you an example. Let's say you backtest a trading system, or a trend following system, and let's say it's the breakout of the 200 days high, and you trade across 50 markets, and you have a 5 ATR trailing stop loss. Okay? And let's say that makes money. But however, if you change, right, the parameter, let's say from 200-day breakout, you change to 150-day breakout, and you realize that trading system loses money in the long run, then you have to be careful because it tells you that the system is not robust. Okay, so when I trade a system, it has to be robust, right? So for example, a trend following system that I trade, right? I trade, let's say for example, breaking out of the 200-day highs, right? I can change the parameter to 220-day high, 179-day high. It doesn't matter, right? The system in the long run will still make money because the system is robust. There is not many rules, it's not over-optimized, and that's why it's pretty darn difficult to break the system down when it's based by logic. When it's something that clearly works. And this brings me to the third point, right? What is the likelihood of the trading strategy breaking down? So again, back to the trend following example, right? When will a trend following system not make money? Well, when there is no trends out there, when the market is in a range, when it's choppy. And ask yourself, right, over the last 10, 15, 20 years, has any market remained in a range forever? Very unlikely. The market is always trending, right? When there is a deviation from its a value, right? The market will trend. When there is fear, there's panic in the market will trend. So you want to ask yourself, right, what is the likelihood of the strategy breaking down? And also, this brings back, to the robustness aspect that I spoke about earlier. If you adjust certain parameters, right, will the strategy break down or will it still hold up? So, for example, you can adjust the breakout parameters. Instead of trading 200-day breakout, you can trade maybe 181 days breakout. How does it work? Instead of having a 5 ATR trading stop loss, you have 7 ATR trading stop loss. How does it work? Instead of trading 50 markets, right, you have 60 markets. How does it work? If after adjusting all these parameters and the strategy still makes money in the long run, this tells you that hey, you're onto something, right? This is something that you would have confident trading in the future because it's a system, right? It's a strategy that is pretty hard to break it. Okay, so these are the few things that I look for to tell whether a trading strategy works or not. Number one, it has to be based by logic. There must be a logic to explain why this system should work. Number two, right, I would like to do a back test on it, right, to find out how it has fared, right, over time. If you can't do a back test or if you're a discretionary trader, then you can go with a forward test approach. And finally, number three, right, what is the likelihood of the system breaking down, right? And what is the robustness of the system, right? If you adjust certain parameters, will the system still hold? Will it still make money? Okay, so with that said, I have come towards the end of today's episode. If you've enjoyed it, right, hit the thumbs up button and subscribe to my YouTube channel, right? The link is all below, and I will talk to you soon.